Hello everyone, my name is Brian Overby. I'm the Senior Options Strategist with OptionsPlay. And our event today is titled Options Pricing, Volatility, and Probability. Basically, you can't have one without the other. And we're going to go into detail on how you find volatility and how important it can be if you like to trade option contracts. So before I get too far along, I want to let you know that I am paying attention to the Q&A box, but we have a PowerPoint presentation and most of the questions will be answered within the PowerPoint presentation. And at the very end, I'll try to address any questions that may be left over at that time. And with that said, here we go. We do have a disclaimer. We're going to be showing some actual live examples today, and they're not meant to be recommendations. Also, past performance is not a guarantee of future results. And it's just important to note that before we get too far along. Here's our agenda. We're going to start with fairly basic, talking about the anatomy of an option contract. Then we're going to get into option pricing models, and we're talking about the variables inside the option pricing models. We'll do a comparison. There's a lot of synergies between the insurance marketplace and the options trading world, so we'll talk a little bit about that. Then we'll look at the more advanced stuff. We'll talk about volatility and the curve, and I'll explain what I mean by the curve. And then we'll look at the quick and dirty math that's behind most option pricing calculators. And we'll do just a little scenario. It's always good to kind of know the guts of what happens in an option pricing model, and that's what that section will cover, and then we'll answer any questions that you might have. Now, more importantly, you might want to get your phones out right now and actually scan this QR code. We do give a free trial to anybody that wants to sign up for one and check out the OptionPlay tools, which I will be showing and highlighting at the end of this webinar today. You can also go to optionsplay.com/signup. All right. So options. Here's the 4 basic positions that you can do with an option contract. Quite simply, you can every single option strategy that's out there comes from these 4 different trades. You can buy a call. You buy that call, you're considered long, and that means that you have a right to buy the underlying stock at a specified price. You can buy a put, and puts are always confusing because if you buy, it means sell. It means you have the right to sell the underlying at a specified price for a limited time period. On the other side of the coin, we are looking also at sellers. Once you sell a call or a put, you are considered short that position, and you are actually referred to as the underwriter of the contract. Usually we shorten that in the options trading world, and we talk about it being the writer. And I'm going to talk a little bit about that when we get into the example using an insurance contract. And then the thing about a seller is that you take on an obligation. You get paid premium, then you have an obligation. If it's a call option, you're going to have an obligation to sell. One way to think about this and where the term call comes from is people can call stock away from you because you take on that obligation. So the term call actually comes from the seller side of things, not from the buyer side of things. Also, when you talk about the put side, if I am the seller of a put, I take on an obligation to buy. So in that instance, I am once again taking on an obligation for somebody to put stock to me, and that's really where that term comes from. So we're going to focus on puts today because we're talking about pricing, and that's the origin of the options trading market, that they were really meant to be insurance products to protect an underlying asset, not tools to speculate. And that's fairly important that you understand that basic concept when you are trying to figure out or get your hands around how an option pricing contract is calculated, why the value is what the value is. All right, so to do that, I'm going to do the most simple example. Most people out there own a car most people that are watching this, not everybody, but most people that are watching this probably have purchased car insurance at one point in time in their life. And it's real interesting to see the synergies between a car insurance contract and an option contract. Now, once again, I'm going to focus on puts because of what I mentioned, and that we're going to think about this as an insurance contract. So the strategy I want you to have in your head as we go through these variables is the protected put strategy. Say we own 100 shares of stock is trading at 90. We buy an 85 strike put. That means that if the stock, our 100 shares that we own at 90 goes down below 85, we can take the stock take our stock that we own and put it to somebody at $85. That's a protected put. It's limiting our downside, but we still own the stock and we have unlimited upside. That's the short of a protected put. So if you're thinking about that type of option contract, and you're thinking about trying to price it, let's go over to the insurance world and let's think about the price of the asset. Let's think about our car insurance that we're talking about. Is the asset a Ford Taurus, or are we talking about a Bentley? Right? There's a difference between the two different vehicles. It's going to cost you more to insure the Bentley than the Ford Taurus just because of pure costs. Now, in the stock trading world, there's also a much difference in cost between different underlyings. Are you buying an asset, or are you trading it on a stock that is a $100 stock, or are you talking about a $10 stock? There's a much difference in the price of the asset just because of the underlying price of the stock. So if the stock's at 100, guess what? It can go from 100 to 0. If the stock's at 10, it can only go from 10 to 0. That's 10 points versus 100 points. And that is going to be reflective in the price of the option contract. Deductible. Car insurance, very rarely do you buy the zero deductible car insurance. Why? Because if I buy the zero deductible car insurance, it's usually quite pricey. So you usually say, I want the $500 deductible, or maybe the $1,000 deductible. And we can handle that in the option contract and the put example that we talked about, the protected put, by the strike price. We talked about a stock being at 90 and you buy an 85 strike put. Well, guess what? You're buying the $500 deductible on your 100 shares of stock. From 90 down to 85, you have that risk, and then from 85 on down, you can grab that stock that you own and put it to somebody at 85. So in that world, that would be the $5 deductible or $500 deductible insurance contract. Now, time is money, as Mama always said, time is money. The longer, a 6-month policy is going to cost you less than a 1-year policy on your car insurance. Plethora of different expirations in this day and age on option contracts, but bottom line is time costs money. The further you go out, the more and more expensive that your option contract is going to be. And then next up, we have carry costs. And a lot of people don't think about carry costs when they're buying car insurance or even an option contract. But when do you pay for your car insurance? Usually you pay before they insure your car, right? You don't pay after the policy. That means that the insurance company gets money up front. And the concept in the insurance world is that if they make a very good interest rate or good money over the life of the policy, then you're supposed to get a discount on your next 6-month policy. That's what the concept would be in a utopian world, but we don't really know that that's the case. But they get your money up front and hold it over the life of the policy, and that means that they're earning interest on it, and that does get factored into the price of your car insurance. And in the options trading world, you have interest rates, but stocks also pay dividends, right? So you don't drive your Ford Taurus around for a quarter and they say, well, thank you for driving our car wrong. We're going to give you some money for doing that. But in the stock trading world, that's possible. So yes, you pay for your option contract up front. So the owner of the contract, the seller of the option contract, I should say, receives interest over the life of that option contract. And also if a stock pays dividends, that affects the price of the option contract. So this is one huge package that we got to think about when we're pricing an option contract. And then we got the level of risk. If you think on the insurance world, I mean, is the person 40 years old, father of 5, drives a caravan, or are they 20 years old, just got out of the Navy SEALs program, might drive a car off the cliff just to see if they can survive, and drives a Mustang? There's a difference between those two profiles, and that's why actuaries use tables to try to determine the level of risk of that person that they're trying to insure. In the options trading world, we actually call that volatility. So you just look at how volatile that underlying stock has been and decide, well, how does that affect my option contract? So for example, Walmart and Amazon, and they're both in the retail space. Amazon's got obviously their web services, but there's a much difference in volatility between those two underlyings. Not a ton of difference, but there definitely is. And so it's going to be cheaper to buy an insurance policy on Walmart. First of all, it's a lower price stock. And then second of all, it's just not as volatile as Amazon can be. So because of that, buying a protective put on Walmart is going to be cheaper than buying a protective put on 100 shares. We're talking on a one-by-one or on a one-to-one basis, is going to be more expensive in Amazon. And when it's all said and done, we call the price of an option contract a premium, just like in the insurance world. So I talk about the synergies between the insurance world and the options world. First of all, the variables are the same that they're looking at when you're trying to price an insurance contract as opposed to price an option contract. Once you price it, you call that price the premium. I'm paying my car insurance premium. I'm paying this premium for this call or this put option. And then lastly, if you sell a contract, in both worlds, you're considered the writer of the contract. Insurance agents, insurance companies, and agents in general are usually referred to as underwriters of the policy. And that's also true in the options world. We just shorten it and we say that if you're selling an option contract, you are a writer of the contract. So now if you approach option pricing as I am the writer of the contract and I need to price this accordingly based off of that information that I just gave, it helps you give a basis for option pricing in general. All right, so I see a long-winded question, and I'm going to try to address that one at the end, Vincent. And then also, before I get too far along here, I also see one from Carl. And I'll try to address that a little bit more too. Today, we're going to try to focus more so on the presentation about volatility and pricing than try to address actual questions more so about the Options Play platform. But I'll try to address those at the very end. So let me get through the PowerPoint and then I'll address everything that I can. All right, so here we go. Black-Scholes model. All right, you notice that everything that we just talked about, if I throw up the Black-Scholes pricing model, Fisher, Black, Myron, Scholes wrote this in 1973, the year the Chicago Board Option Exchange opened their doors and first started trading listed options. You see, all those variables that we talked about are in here, in this pricing model. And once you put those variables in, and one thing I want to also focus is you see a lot of square root of t's in here, right? You see those all over the place. And that's going to be fairly important when we start getting into the quick and dirty math of an option pricing matter. The square root of t is an important concept. So now we're going to spend the next 45 minutes deriving this formula and making sure they got it right. Just kidding. There's no reason to do that. And part of the reason why is that there's been a lot of models that have been done ever since the Chicago Board Option Exchange first started trading listed options. And the people that are down on the floor, the model matters a lot. They're trying to trade for nickels and dimes and pennies. And we're not. We're retail clients. We're trying to buy an option contract and get the direction right. We got the benefit of knowing that we're going to either buy a call or we're going to buy a put, and we know what strike price we're going to buy. On the trading floor, they don't. All they do is interact with your order. So we make that choice. They have to trade it. Now, they might have to buy, they might have to sell, and they might get a benefit of getting a little bit better price than us because they're buying on the bid and selling on the ask. But I've had this happen many times before when people come in and they say, I ran a Black-Scholes pricing model and the price of the option contract is way more than what the model says, than what my model says. So could you call the floor and have them update their quote? I have had that over the 30 plus years of teaching and executing options and working for brokers. I have had that question asked of me more than once. So that is a fairly important question to understand as we move on to the next state, because that just doesn't make sense. The price is what the price is. You see the quote, you see the quote. That's simple. All right. So bottom line is these are the pricing components of an option contract. You have the stock price, the strike price, the expiration date, interest rates and dividend, implied volatility, and premium. Put that into Black-Scholes model, Cox-Rubenstein model, whatever model you want to use. you will come up with a price for your option contract. Now, out of all of these variables, these are pretty straightforward, right? I can get a stock price. I can get a quote on Walmart if I want. Strike price, I determine. I select what strike price I want to interact with or buy or sell or whatever, however you want to call it. Expiration date, well, I can figure out the days to the expiration. Might have to take my shoes off, but I can count backwards and get to that expiration date. And then we have interest rates and dividends. The interest rate is going to be kind of the short-term money market rate, if you will, but that interest rate is fairly easy to find, and obviously we can get the dividend yield. Implied volatility. Now that's a little tricky if you're a retail client. Like, what is the correct implied volatility? And my answer to you is, I don't think we care. We know that we want to trade an options contract, and then if implied volatility is higher, it's going to cost us more to trade that. But we want to use this as a tool. So we want to know what that number is. Now, we can find the price of an option contract just by getting a quote, looking at an option sharing, and we can do that. But this is the biggest question. What is an implied volatility? And why is it called implied? All right, so to answer that question, first of all, let's define the terms. There are two types of volatility out there. We have historical, which is the annualized standard deviation of stock price movement. It's already happened. It's a fancy way of saying that we looked at the highs and the lows day in and day out, and we looked at how volatile the stock was over this period of time, and we came up with a historical volatility. It doesn't necessarily mean that the stock went up or the stock went down, but we can look at the past, look at the stock price movements, and we can decide, and we can come up with a number that we'll call historical volatility. Now, what's big is it's annualized, and that if it doesn't say 30-day or 60-day historical or 90-day historical, it's considered an annualized number, and that's fairly important if you want to, once again, understand the guts of an option pricing calculator, and that's what we're going to focus on today. Now, implied is the volatility that justifies a current options. Try that again. It's the volatility that justifies an option's current market price and is also stated as an annual number. So once again, if it doesn't say 30-day implied, then it's assumed to be an annual number, and it can be found using an options pricing calculator. Well, bottom line is, if there wasn't an option contract, if the stock does not trade options, you can't find an implied volatility. That number just doesn't appear on stocks that don't have options. Why? Because it comes from the price of the option contract. Supply and demand has a lot to do with where that implied volatility number is. You also got market makers on the floor. Somebody's model says that the vol should be this level, and someone says it should be that level. They might trade to try to arbitrage what they think they have a benefit on. But bottom line is, if that does not trade options, you cannot find an implied volatility for the underlying stock. Okay, so if we're looking for implied volatility and we know all of these components, well, how do we do it? Well, it's just a little bit of algebra, just a little simple math here. So if you have your model, you take your Black-Scholes pricing model, you put it up there, you put all your variables that you know in, you know the price of the option, you know all these things we already talked about, but I don't know what implied volatility is. So let's take implied volatility and move it to the other side of the equation, and then let's take premium and move it to this side of the equation, and let's solve for implied volatility. So basically we do a shim-shammy here, and we come up with a pricing model that doesn't solve for the price of the option contract, it solves for the implied volatility. And I've worked at many brokerage firms over the years, and we do this. This is, if you're calculating your own Greeks, which a lot of brokers will do in this day and age, they'll use their own proprietary model. So if you get a delta on underlying stock, it's not uniform across all brokerage firms. The deltas are usually very close, but they might be different at Fidelity than they are at Schwab, or the company that I started up, which was called Trade King, which then eventually became Ally. So when you're talking about the price of an option contract, what we would do is we'd use our model, calculate our delta, our theta, all these fancy Greeks, and then take the price of an option contract and extract the implied volatility. And that was probably the most accurate of all the numbers across most of the platforms, because most of them are doing this calculation. That simple. I'll answer Rick's question real quick, and I'm going to keep the other ones in here. I'm going to answer this one live. Yes, Rick, I can calculate without a I can run a Black-Scholes model and calculate a price just with a standard calculator if you know all the variables. Yes, it's very possible to do that. Okay, so now that we know implied volatility, now that we've gone and painstakingly figured out how to find an implied volatility for an underlying stock, that implied volatility will go with that expiration for the option contract that we chose. Wherever we chose that price, that premium, that implied volatility will go with it. Now, across the board, the standard is to use the most at-the-money option contract for expiration that you want to figure out the implied volatility for. So like if I want to use the January 3rd Friday of the month standard option contract, I use the most at the money in that January expiration, and that's what we would call as the implied volatility for the January expiration date. And that's the way we would figure it out. Now, once I figure it out though, how does that benefit me? How can I use this information to trade? And the answer is a 1 standard deviation move. Once I figure that out, I can then calculate what is considered a 1 standard deviation move. Don't let that term scare you, because all it is the bell-shaped curve, right? Have you ever traded on a curve or ever been graded on a curve by a teacher, right? They take the bulk of the class and they take the highest grade and they put that up above, maybe throw that one out, throw one out on the bottom, and then they look at where the bulk of the grades came in at, and that's where they start with this is a C, this is a B, this is an A, right? They grade on a curve. All right. Well, in the options trading world, it's a log normal distribution, and once again, don't let that worry you, but we're going to look at it as a very basic, just normal distribution. And I'm going to show the math behind it. And once again, we're just trying to get a concept of option pricing here and how this might help us if we're trading options. The reason, let me go through it and then I'll talk about log normal one more time before we get all through, all right? So if I have a stock trading at 100 and I have an implied volatility of 20%, I can calculate what's considered a 1 standard deviation move. A 1 standard deviation move would be 100 times that volatility, or 0.20 on a percentage basis, right? 0.20, and that would be 20 points. And I made the math extremely simple here just so that the example is easy to get through. And once I do that, then I know that most of the time the stock will stay within a 1 standard deviation move, 20 points to the upside or 20 points to the downside. So I can draw a curve. And here's the way my curve looks. And this is the bell-shaped curve that you've heard of. You may not have, you didn't have to take statistics in college or high school or whatever, but the concept of the bell-shaped curve has been around for quite some time. The stock was at 100. We take 100 and we add 20 points to it, and that becomes 120. We take 100 and we minus 20 points from it, and it becomes 80. And the math or the statistics that's behind it says that 68% of the time, if you take, and I don't care if the stock symbol is IBM, if it's Walmart, if it's 3M, if it's Tesla, it doesn't matter. If you look at implied volatility, and this is the way the market makers think, that are on the exchanges that are trading options, is if it's a $100 stock with a 20% implied volatility, that is implying that 68% of the time it's going to be at 120 or 80. And if you do this a million times and you come back, 68% of the options that trade around $100 with a 20% implied volatility should land somewhere between 80 and 120. That simple, that straightforward. I don't care about the fundamentals of the company. I don't care if the Fibonacci ran into the moving average and hit a Bollinger Band. None of that matters to them. This is where most of the stocks will land if you do it this iteration a million times. That's what the concept is, and that's what gets put into the pricing model. Now, it's got to add to 100, so that means that 16% of the time it should be above 120, and 16% of the time it should be below 80. All right, and I didn't mean to click that just yet, but that's the definition of a 1 standard deviation move. And if I look at this, this will add up to 100. Now, here's the question. What time period are we looking at here? We said the implied volatility is 20%, so let's see if you're listening. What time period are we talking about? Well, it's an annualized time period, right? Because that's what we said. If it doesn't say 30-day, 60-day, 90-day implied volatility, it's based off an annualized number. So they're saying here that if you take a stock that's trading at 100 and you look at the most at-the-money option contract, you see that it's a 20% implied volatility. On a yearly basis, if you come back after a year's time, most of the stocks will be trading with, if they trade with that vol, somewhere between 80 and 120. That's the concept. That's where 1 standard deviation move comes from. Okay, so since I clicked on the definition already, I'll go here and I'll just say a 1 standard deviation move is the expected price range for an asset that contains the future price about 68% of the time. It's a reference point that's based on implied volatility asset, which is the expected range of movement over a year. Okay, so a lot of people just stop there when they're doing a presentation, and I don't know if that's really fair to do because this is in 1 year's time, right? What that standard deviation is. And so this is the range of outcomes, but that's at expiration. That's meaning that this stock could go from 100 up to 140 and come back down a year from now and end at 119 and still be within that range. Let me say that again. The stock could go all the way up to 140, come back down and close here right at 19 and still be considered within a 1 standard deviation move. Okay, so if you look at some brokerage firms, you will see that they also talk about a probability of touching. And I know that in this day and age can be a nasty phrase to say, but a probability of touching means what's the probability within the life of this stock that we're talking about, we'll just call it XYZ, actually reaching 120, of just touching the number, or actually reaching 80, or just touching the number. And the math kind of works out, because we're just talking about quick and dirty math, that it's usually about double what the probability of finishing is. So if it's 120 and we see it at 16%, if you want to do quick and dirty math, it usually means about 32% of the time it's actually going to at least touch that over the 1 year period. Might finish in this range, but it could touch that. And that's a much higher probability of happening than probability of finishing. So there's always an argument, should you just put a trade on and just let it ride and not manage the trade? Or is it better that once it touches that strike, you adjust your trade? But if you think of probability of touching, there's a lot higher chance that the stock will at least reach that number over that expiration or that life of that option contract. And it's just something to keep in mind because a lot of people don't mention that when they're talking about 1 standard deviation moves. All right. And Richard asks a very good question because we're on it, and it's a great question. He says that at his brokerage firm, every expiration shows a different implied volatility. Is that an annualized or just for that expiration? And the answer is that it is annualized. And I'm going to go through how a distribution curve gets disseminated as far as what the expected move, the plus or minus number that you see, Jonathan, and how that gets calculated. But yes, every single expiration is quoted as an annual number and then adjusted for the time period. And that's what we're going to address next. Thank you for your question. All right, so implied volatility table. All right, now here's what I've done is I've taken our math that we have behind the calculator, and I use quick and dirty math, and I'll show you on my website, OptionsPlaybook.com, which is the book that I have written on options, and I turned it into a website. I will show you, if you want to read more about how to get to this table, and I'll show you that at the end when I go to the actual web. But 20% implied, if you have an annualized implied volatility of these numbers, obviously over the short term, over 30 days, the potential for the stock to move is a lot less than over 90 days. And we're just talking about the expected move, the one standard deviation move, the possibility of it going, well, 16% on the downside, 16% on the upside, 68% in the middle. That number becomes greater as you go further and further out in time. And that's quite simple, quite straightforward. Now, if you're talking about a utopian marketplace and you're just looking at volatility, here is the formula that I use to calculate that chart. And back in the day, prior to all the fancy tools that all the brokerage firms have now, and when I used to work on the Chicago Board Option Exchange or at the CBOE, which is now called CBOE Global Markets, which is just a weird name, but that's a topic for a different time. All you're going to do is you're going to take the implied volatility on an annualized basis, and if you've got a 360-day calendar, like I said, and here title says it's dirty, it is dirty, because we have 365 days in a year, not 360. But you would just take the square root of the number of 30-day periods. And once again, remember when I said the Black-Scholes model, you see all these little square root signs that are in there? Well, this is where it applies. And are you ready for this? Okay, everybody sitting down? I can't see out there. I don't know. But you got to get ready. Here you go. Options move at the square root of time. I know it's an exciting concept. You might want to go on Facebook and tell all your friends and family all about it. But bottom line is, it's actually a pretty accurate number. The math that's behind the difference between a 90-day option contract, a 60-day, and a 30-day option contract, at the money option contracts is what we're talking about. This math actually works fairly well. So here's the way that I calculated the table. And I'll show you the table again, but for the 60-day, I'm going to focus on the 20% implied because that was our standard deviation that we were looking at. How many 30-day periods are in a 1-year period or 360 days? And the answer is there are 12 periods. So you take 20% divided by the square root of 12, and you come up with a 10. Oh, I got these backwards. Shoot. I got to go back and do that. No big deal. But I flipped the script when I put the presentation together. So this would be at 5.75%. On a 60-day basis, 20% times the square root of 6 would be, I got that one right because it's right in the middle, 8.7%. And then 90 days, 20% divided by the square root of 4, which I can do that one in my head, that's 2. And you come up with a 10% range within that 90-day period. And by range, once again, we're saying 68% of the time. That's what we mean by the range. But this math actually is fairly straightforward. It's fairly accurate if you're in a utopian world and also in the real world marketplace. There's actually another formula that you can put together. And once again, I'll show it to you on my website for a different time period. But my whole thing about this presentation today is that if you get it, if it clicks, there's no real reason to know this formula anymore. You just need to understand where it came from and what's behind it and how it can help me, more so than trying to memorize this quick and dirty formula on how to calculate the percentage move over a certain time period. Okay, so once I do that, yeah, I changed that up, I apologize. 10 goes here, 5 goes there, and yada, yada, yada. But I did it in the table. So I corrected myself this way in that We have a 20% implied volatility. 30 days, 5.75%, 60 days, 8%, 90 days, 10%. And then you go to your brokerage firms. All right, Michael's in the chat box. Michael, you want to put your question in the Q&A box, but we answered this one live. And let me see what Michael says. Oh, you have an error. Yes, I do have an error. I flipped that around. Thank you for highlighting that error. And put your questions in your Q&A box, please. Implied volatility. If I look at it, I have 20% implied, 30-day, 5.5%, 6%. I can take this now and I can do a probability distribution. Now remember, our number that we looked at, if we were looking at our table, if we were looking at our chain, and let's say we were looking at a 1-year option contract, or even let's say we pulled this off of a 30-day option contract, and we saw that it was implying 20% implied volatility, all right? Well, we can come up and say, well, on an annualized basis, that means that over 30 days, the stock price would be up or down by that 5.75%. Yeah, 5.75%. Once again, I made the math very simple. So the range, the expected range, which happens once again, 68% of the time, for a 30-day period is between 94.25 and 105.75. For a 90-day period, it's 91.83 and 108.17. And on a 90-day, I said 60-day period, I hope. And then on a 90-day period, it's between 90 and 110. Once again, if you ride it all the way to the expiration date, you got a 68% chance that the stock will land somewhere in the middle here. And you're seeing more and more brokerage firms come up with this little distribution just to try to give you a good feel for what the options marketplace is trying to tell you. Okay. So in this instance, if I go back, let's jump back one. Let's jump back one here. And yeah, I think I'll go right here. Okay. So on a 90-day period, the stock is at 100. I have a question for you, and somebody's got to play in my reindeer games. You can answer in the chat box or the Q&A box if you want, but I'm going to ask you a question here, and I want you to think about this. Let's say you're a market maker down on the trading floor and the stock is at 100 and you know this, and somebody comes in and buys a very basic trade, but what they do is they buy the straddle. They buy a call, they buy a put, 90 days to expiration, and the stock is at 100. All right? 90 days to expiration, the stock is at 100. They buy a call and they buy a put in order to buy that long straddle. What would you sell that straddle to them for? What would be your price? What is the price of that long straddle? The price of the call and the put added together. What would you sell it to them for? You know this information, you know this distribution, you know this probability. Do you know what you would sell it to them for? And I can't go on until somebody answers that question. Nobody wants to play in the reindeer games? Okay, we've got one answer. Lawrence says $20, and that's a common answer. You got to add the call and the put together. Yes, so what if you, Jerry, if you added the call and the put together, what would be that? There's the right answer. Jonathan came up with the right answer in the chat box. The right answer is $10. And the most common answer I got was the first one that came up with Lawrence when Lawrence said $20. And the answer there, Lawrence, is you doubled it. You went too much, right? So basically what you're saying is that the call and the put in a utopian world would be both trading for around $5. And if that's the case and you buy the long straddle, 68% of the time, the long straddle doesn't make money. And the market makers know that. They know that. So I'm happy to sell it to you for 10 points because remember, the stock is trading at 100. And 68% of the time, if you ride it all the way to expiration, it's not going to move 10 points to the upside or 10 points to the downside. It's going to trade somewhere between 90 and 110. So that's the concept. So now the reason why I bring this up is that I'm not saying you should do long straddles, not do long straddles, but I don't know if you've ever heard that people will come up and say 7 out of 10 long straddles don't make money. Well, obviously they're just rounding off. They're saying 68% of the time they don't. 7 out of 10. That would be 7% of the 70% of the time. So if you're doing long straddles, there's a little bit of a moral to the story here, is that most of the time they don't make money. And that's just because of the way that the options are priced. And when they do make money, you got to let them run. So the thing about a long straddle is all of a sudden you get profitable and you say to yourself, oh, I want to get out. I made money. But that's not really the way that it works. If you think about, this is, a utopian marketplace, but you have the black swan events that happen all the time. Obviously, this is the distribution. We got to come up with a way to price. But in the real world, that 1% chance of that stock blowing it away and moving 50 points, for example, in our $100 stock situation, that happens a lot more often than what the actual math says. And so the concept of a long straddle is if I do 10 of them, I got to let the 3 that run and that win for me, I got to let them run, and I got to make up for all the losses that I had on the 7 that I didn't make. I'm trying to use very simple math, but if you understand this concept, then it makes it harder to do long straddles, right? It makes it harder for the concept of buying a long straddle. Now, Sheldon Natenberg's book kind of highlights this. Now, it's a little less than a 1 standard deviation move, and I just want to let you know that. But the concept is still fairly accurate. It's about 80% of a 1 standard deviation move, but that's not the point. The point is the market makers know this, and this is why they're selling it to you for that price, and the math all kind of works out. All right? I hope that was useful to you. And then on the other side of the coin, if I'm going to go out and I'm going to sell an option contract. So let's exit this and let's jump back to this one. Okay, so let's say I'm going to sell an option contract, right? And I want to have a high probability of success. So I'm going to sell a call option. I might buy protection. It might be a short call spread, which is bearish. So I would sell the 120 call and maybe buy one a little bit further out, maybe the 125 or so. If I'm doing that, well, the math says that 68% of the time, the market's going to be below 120, and then I can add 16% too, right? Because it could go below 80 16% of the time. So there's an 84% chance, if I hold this to expiration, that this stock might finish below these prices. And I say this to people, so this is a number that I want to be aware of if I'm buying a long straddle, or if I'm selling a short call spread, or on the other side, I'm selling a short put spread. And then I usually get somebody say, well, I want a 100% chance of success. All right, well, now you're way down here or way up here, and guess what? You're getting nothing for your option contract, right? So if the marketplace is saying there's hardly any probability of the stock reaching that strike price, well, then you're not going to get anything for that option contract. So at 120, I still got a 16% chance that it might hit. And I always like to say this to people, because a lot of people say, oh, it was only a 16% chance. There was no chance of that happening. No. It was a 16% chance. And that means that can happen. And also, we're talking about probability of finishing, not probability of touching. Okay, so first of all, to address the 16% chance, how often do you hear weathermen say, and weather people, to be more fair, I guess, is what weather people will say is that there's a 16% chance of rain. Think to yourself, how often do you hear that forecast and then you get up in the morning and it's raining? It happens, right? It's the same concept. If there's a 16% chance of it happening, it will happen. Now, a lot of people get confused by this because, once again, they're saying, oh, the stock ran up to 120. It can go to 120 and go up to 130 and still come back and finish below 120. This is at expiration. This isn't probability of touching. So the numbers are a little bit higher, and I think that is if that's the one takeaway, if you've seen people talk about 1 standard deviation moves before, that is an important concept that you want to take away from this. Okay. Well, Jonathan, so Jonathan makes a statement and says this is why iron condors are more profitable than doing long straddles, and that answer, that's an argument, Jonathan. Ideally, here's what market makers think to address Jonathan's question. Jonathan says that iron condors are more profitable. Now, where the argument comes in is the fact that Jonathan said more profitable. If Jonathan said that iron condors make money more often, that I would agree with. But more profitable is kind of hard to say. So in general, the way a market maker thinks is that if you sold an iron condor and implied volatility came in, went down, right? Well, then in that scenario, iron condors should make money more often than buying options or long straddles. But if you put on a trade and you buy a long straddle and implied volatility goes up, well, then long straddles should do more. So let's just talk about a period of general implied volatility. Heading into the election, if volatility via the VIX index rose from 16 at the beginning of, well, I'd say the end of October, beginning of October, heading into November, well, the concept would be that long straddles probably did better than iron condors because implied volatility increased over that time period. Whereas now volatility has drifted down, you would think that iron condors and selling option contracts would have done better after the election because volatility has came in on those positions. So in periods, if you just think about it in a vacuum, in periods of higher volatility, buying options should be more profitable than selling options. And in periods of detracting volatility, where volatility comes in, selling options should be better than buying options. And that's really what the theory is behind market makers down on the trading floor. And that's why they're trying to get their volatilities right. No, Al, I'm not saying anything about trading. This is nothing about trading straddles or strangles or short call spreads or anything. This is a presentation on option pricing. And if I don't give examples as to why you need to know this or why this is pertinent by talking about specific strategies, notice I don't have an underlying stock. It's XYZ. It's just called stock. It's at 100. Then it's hard to grasp why you're pricing it and why you're doing what you're doing and why you're even spending your time here. So that's what I'm doing. I'm saying if I am a seller of an option contract, this number right here is fairly interesting. That 120 strike, I can still get something for it because there is a chance, but there's a high probability of success that the underlying is going to be below. So this is a very popular option contract to sell on a stock that trades at 100 at 20% implied volatility. It doesn't mean that I should buy the long straddle. But I'll give you some background on just from my years of trading. I will do long straddles from time to time. I don't believe the concept, you always hear that 80% of option contracts always expire worthless, and that's just a misnomer. Quite simply, most option contracts don't make it to expiration because what do? You put on a trade, and if it's going your way, you close it, and then that option contract ceases to exist. So about 65% of the time, options get closed. They don't even make it to expiration. About 10% of the time, they get exercised or assigned, and then whatever that number is in the middle are the ones that actually expire worthless, which isn't bad if you've sold the option contract, right? 65, 75, so 15% of the time or so, options will expire worthless. And these are the numbers. The Options Clearing Corporation puts these numbers together. It's inside my book, actually. I can run over there, be a little bit more accurate because I took it for a 1-year period. I actually got the numbers from the Options Clearing Corporation. And they don't change much. They really don't. Most of the time, people put on a position and let that position go, and then they close it out. So in the insurance world, you might do that too. You don't always have to ride your policy all the way to the end. You might, like the little lizard on Geico, and say, all right, I'm going to close out my policy with Allstate, and I'm going to call up Geico and open a new policy with them. And then Allstate sends you a check for the remainder of your time inside that option contract. It's the exact same thing that happens with the options trading world. But it's much more liquid, and you can get in and out a lot easier. You don't have to spend 20 minutes on hold with the Geico lizard. All right. I hope somebody chuckled at that a little bit. Jocularity at this point in time. All right. We're getting close to the end here. All right. So inside the Options Play platform, we get fancy, right? We just did the math that's behind it. We actually have a trading range simulator, and I tried to pick a stock that was around 100, so I went with 3M. Stock was at 128, and what it's going to do is it's going to calculate this time period. I picked a January 17th time period, almost 60 days. It's going to take the implied volatility, which is, you can find on the site, the implied volatility that it's using is going to be based off of that expiration. And they're saying a 23% implied volatility, and this shows you the 1 standard deviation move. And then if you go out to a 2 standard deviation move, the bell-shaped curve and the math and statistics and all that says that that should be should happen 95% of the time. And now we're looking at a bell-shaped curve. So what this is calculating, and when you get into the math, we did quick and dirty math. That means that there's an equal probability of the stock going unlimited to the upside and unlimited to the downside. A log normal distribution takes into account that the stock can only go to 0. So it skews it a little bit to the upside. Not that it really matters. This is a nice, pretty picture. And these are the numbers. The numbers are what the numbers are. And over the 60-day period, and you kind of see this too. I think it actually is showing you a little bit more upside potential than downside potential, mainly because of over that time frame, because there is a little bit of a skewing to the upside on all pricing models because of what I just mentioned. All right, so there's the free trial. Here's your opportunity to scan it. My name is Brian Overby, and we're going to run to the Options Play website. I'm going to show you a few more things, but don't forget you can go to optionsplay.com/sign up. This is my book. My website is optionsplaybook.com. I'll show you that in a second. Here is the Options Play platform. You can. There's also an app that you can go to for optionsplay.com. You can find me on X if you want to know what I'm doing. My handle is @BrianOverby, and I see a lot of questions that are in there. I will pull up the Options Play platform. And let me expand it a little bit here. And I think you can see that now, okay? And this is what I have. I have 3M in here. We have, if you're looking at the P&L simulator, this will actually draw pictures across all of these graphs. As I move it, notice the line moves. This is all based off of that pricing calculator and that theoretical price. I can move implied volatility and see how that affects the profit and loss on my positions. And then if I want to see the trading range, I can take this and I can move this out a little bit and see where the probability is there. I can move it in a little bit and say these are my strike prices that I want to sell. And if I go to the outside and I go all the way out, now I'm more than a 1 standard deviation move. And it's a very, very simple, easy to use calculator that does actual math, not quick and dirty math. Okay. Now, I was talking a little bit about long straddles, and from time to time I will do a long straddle. I'm going to tell you the 2 positions, and I actually did them in webinars that I've done recently. One of the long straddles that I did is if you go back and you look at IWM. IWM was trading at a very tight trading range for months and months and months until the Fed decided to start cutting. Now IWM and the Russell 2000 index is all over the place, and good, bad, good news or indifferent. Let me see if I do this. Now, once again, I'm just going off the cuff here, right? But it was a very solid trading range, and there you go, right there. That was it, from highs and lows, highs and lows. Implied volatility was nothing amazing. Like if you look here, we hit this 235. Right now it's trading at a 21% implied volatility. But if you look at this range, we're looking at 200 to 220. So a couple of times when the market got up here at the higher end of the range, either it's going to break out and it's going to take off, or it's going to go back into the range and probably go back down. Did a long straddle. Did a couple of these, mainly because I don't want to do a long straddle around news events. I'd never want to do a long straddle around earnings because it's a known event. And so that is not a time I want to. But if I'm in this situation where I think the underlying might take off, I wish I could get rid of those crosshairs. I think I can. All right, where the underlying might take off, well, this is a chart that entices me to think about a long straddle. And look at what happened here too. So if you would have did it at this trading range, boom, we moved all the way up to 240. We went from this range where you'd want to be, well, it was a gap up, but right around here, around 225, and look at that gap all the way up to 240. Now, do I want to mess with it anymore? No, there's no defined trading range. There's nothing on this chart now. It's trying to figure out where it's going to go. We don't know what the Fed's going to do, but this would be an underlying that I would consider long straddles in, as opposed to doing iron condors. So that makes sense. Other things, way back when Boeing was having all their issues, which there's an argument they're still having a lot of issues, but bottom line is when the MAX was crashing, and planes were grounded, and they didn't know, and there was news almost every week that was coming out that was saying they might fly next month, they're not going to fly for another 2 quarters, they found another thing wrong with it. And the market was getting blindsided by news. It wasn't an earnings report, it was just the fact that there was a lot of question marks. Boeing, why not? Right? And I did a lot of long straddles in Boeing, and they all panned out. Now, if I'm doing a long straddle, though, too, is I don't mind if the market moves strong in one direction and I can be profitable just from one of the calls or one of the option contracts, I will do that and let the other side run. You know, that's a very, very feasible thing to do. So like in this scenario here, right here where we did a long straddle, you buy the put goes down and it starts trading here. I'll just sell the put and let the call run. Don't have any problem with that whatsoever. And that's actually what I normally would do with a long straddle. And then you come in and you talk about a long strangle. I really don't do long strangles, mainly because if you do a long strangle, you're giving up a lot of delta on the option contract that's working for you. And you need that one option contract that gets in the money to make up for all the losses on the one that doesn't. And this is what I mean about understanding option pricing and understanding things like this. If you get a grasp on it, I don't ever want to do a long straddle, especially over a shorter time period, because with the strangle, I'm almost always going to make something, right? Because you're talking about buying the 100 strike call and the 100 strike put. The only way I lose everything is that if I ride it all the way to expiration and it lands right at 100, I'm going to probably make something. So I pay a little bit more up front, but I'm going to get something. If I do the long strangle, there's a chance I might not get anything at all. If I don't watch myself and watch my trade, both options could expire worthless. All right. Once again, not an argument to do long straddles or anything. I'm just talking about if you understand option pricing and you understand these concepts that we're talking about today, it will make you a better trader overall. That simple. All right, now I'll answer some of the questions. Oh, so here is a section inside my book on implied volatility. There's also a section called Meet the Greeks, if you put in the Greeks that I have a couple of videos on too. So if you want to check it out and support me, this is my company, this is my ugly mug. But if you want to do that, please check out our website and click on buy the book. And we actually get some commissions from Amazon if you do that all the way through. Please send this suggestion to OptionsPlay. All right, let me look at that suggestion. And let me go back to here and let's go slideshow. And you can stare at my ugly mug and the free trial thing that just is enticing you to get your phone out and scan it and sign up for OptionsPlay. Okay, let me bring these questions over here. Let me go to the Q&A box to all the people that listened to me and said that they would do the Q&A box. All right. Here we go. Because the Q&A box gets priority over the chat box. That's simple. Okay, so I addressed this. Q, I don't want to butcher your name. Can you compare a straddle versus a strangle? And I just did. I never do strangles long. I just don't. I mean, I'm in IWM, let's say, and I want to do a 6-month long strangle because there's a lot that's going to happen with interest rates and the new administration and all that. Maybe go out of the money and do it, but that would very far. Usually I'm doing a long straddle, I'm doing short-term option contracts, and I'm doing it because I think the market's going to be blindsided or I really like what I see on the chart. Okay, that one's answered. I signed up for the 1-month subscription. Okay, Joe, if you send it to support at OptionsPlay, that can be done. Now, think of this. I'm an independent contractor, so I don't work. I do a lot of work with OptionsPlay and going forward. But this is something for the support desk. I've never been on the support desk for OptionsPlay. Okay, Joe. Sorry about that. Price of the straddle. Answer that. Yeah. OptionsPlay always recommend 45. Okay, OptionsPlay always recommends 45 days. How do you calculate implied for 45 days? All right. Well, you can do it by looking at the pricing simulator and pick an expiration that's 45 days out. So this is, I should probably repeat the question from Tariq. OptionsPlay recommends 45 days. How can you calculate implied volatility for 45 days? All right, I'm going to take this opportunity to show you something. So the presentation is getting a little bit long-winded. I wouldn't worry too much about it, but let's do this. And if you scroll down here, this is that little chart that we looked at. This is the calculation, the quick and dirty calculation, not for 30, 60, 90 days, but actually this is for 45 days. Interesting. All right, so you can read this inside Options Playbook. Everything's free in here. There's no sign on, there's no anything. Everything's free. Just check it all out. All we need is we need eyeballs, right? That's what we're looking for. All right. Price of the straddle. Answer live. Done. Michael, so for 1 day IV, you calculate 20% square root of 35 or a number of days? Yeah, you do, Michael. But Michael, when it comes down to 1 day and implied volatility for 1 day, models kind of break down. It really doesn't work very well. And that also happens with Greeks, delta, gamma, theta, vega, those type of things. Models don't work well on a 1 day basis. This is for a real option, if you will, right? And if you are going to use it, don't try to use my math. The quick and dirty math definitely doesn't work well when you get to very short time periods. All right, is that fair? Joe. Done. Okay, let's see if we got any more questions in here. App. All right. Done. I think I showed this. Cheap options. If cheap options are an edge, does OptionsPlay software pick the best priced options based off of helping with the attractive underlyings based on technical analysis? Yes, there are some searches. And in general, there's some technical analysis ideas, and then you can come in and search. Come on, work for me. Covered calls. That will basically go in and find stocks where the price of the call. There, of course, the call option is assuming that you own the stock, but it's basically pricing option contracts that have some volatility and some predictability on certain underlyings. And then obviously you can do searches for credit spreads and short spreads. And we'll leave it there. Well, Martin, okay, Martin says a real world example. So let's use this example here, right? So if Martin asks me to show a real world example. If I know this information and I'm looking at well, let's go back to NVIDIA, NVDA. Let's do NVIDIA. They just announced earnings. Vol has came down. And we're looking at the trading range simulator. Market is at 146. All right. If I wanted to sell a call option, this would be a popular one to sell, somewhere right around 172. 172 and a half is where that one standard deviation move is at. So let's click modify. And the trading range simulator, what was this for? January, we'll go 57 days. Not saying that we should do 57 days. I'm just saying that I'm going to use this as an example. I would click trade here. I would click modify. I'm going to use that expiration. We're going to sell a short call. And we said 175. Let's grab a strike. 172. That's exactly, see, it's showing you one standard deviation move on this, and I can bring $2.96 for 57 days. So, moral to my story is, if I was going to sell that option contract and I was looking to sell one, I know there's a high probability of success by selling that, and I also know that I'm still going to get something for it. $2.96 for one option contract is $296 per contract. And if I start going out further than that and I get beyond the one standard deviation move, well, the price of the option contract is going to go down immensely. Let's go all the way out. Okay, so here's the one on the outside. So this, if you look at the math, so 15% chance, which is what this is showing me via the delta, that's 181. Not bad though, a lot of premium still. So let's go up to 190. We go up to 189, 190. Okay, now we're still getting $1.14 for that option contract. That's not bad. It's not bad on NVIDIA. It is 57 days out, but we got a very low probability of success of that actually finishing above that strike. It's going to be right around 10%, and you can see that inside the trading range thing. We'll take this up to 190. All right. So now there's 40, yeah, it's about a 90% chance because you're taking 40 plus 47, and then whatever is remaining here is the probability of it being below the 190 in this instance. All right. Okay, so anonymous attendee asks, can we please clarify how high volatility favors selling options and vice versa? And I think the moral to the story is it doesn't. Implied volatility being high doesn't necessarily favor people that are selling option contracts. It's saying that there's a higher probability that the underlying stock will move. And so being high means I might, if anything, it might be a scenario where it's too good to be true. Right? You look at something, you say, gosh, that's a lot of premium that I'm bringing in for that option contract. I want to sell it. It feels too good to be true. Well, guess what? There was a merger. There's somebody a buyout. There is earnings report that's coming. There's a reason why it's trading for that implied volatility, and you might get blindsided by it. So if the market is efficient, selling in periods of high implied volatility should still give you the same type of probabilities as the pricing model says. So if you're selling a $100 stock with a 50% implied volatility and that's all that you sell, well, and you do it a million times, the stock still 68% of the time should finish within that range. So that's what efficient market theory would give you. There is no favorite because it's high or it's low. Now, if there's low volatility, Intel is a great example. It's just a stock. It doesn't trade with a ton of volatility at this point in time. You just don't get anything for it. So here's the oxymoron that I always like to say when I talk about selling options. What's the ideal situation? You want some volatility with some predictability, which is 100% an oxymoron, like jumbo shrimp. right? It doesn't really work together. So what do I like to sell options on? What's the simplest thing to do in Iron Condor? What's the most popular thing? The spiders or the SPY or the SPX. In general, SPX, a lot of people like to sell Iron Condors because the definition of an index is some volatility with some predictability, right? In the SPX, very often, how often do you see the market open, gap open 2% up or 2% down? It might move 2% in a day. That would be a big move in the SPX. But gosh, in the stock world, that happens all the time, right? Gets blindsided by news. You can't really react with the option trading market. So some volatility, some predictability, that's your ideal situation. And that's where I'd like to be when I'm trading option contracts, doing short spreads, doing just selling options in general. Okay. All right, 525. Wow, I'm way over. I don't know. IWM is an ETF, no earnings, right? Yeah, Aaron. I mean, IWM is an ETF that tracks the Russell 2000 index, so very sensitive to interest rates because it's all small caps, small banks, regional banks. There's a lot of regional banks in it. So you do get more, definitely more volatility overall, but there is no earnings in general like there is with an underlying stock. You're going to have a group of earnings, right? When doing the long straddle, what is your days to expiration? Short. That's simple, right? On IWM, if to go back to that example, we're sitting right on the precipice. You want your option to be explosive in either direction. And shorter term options will have explosive delta because of gamma. And if you want to know more about that, if you want to know more about that answer to that question, you can go to my website and look at that section called Meet the Greeks and watch the delta. I talk a lot about explosive options. So if I'm buying long straddles, I'm not going out more than 2 weeks. I'm doing it because the chart is saying something. You know, in Boeing, when they're deciding if the planes were going to fly, I don't know. Maybe 20 days, but you want your option contracts to be explosive, and nearer term option, at the money option contracts are much more explosive than longer term. Okay. ADI. Okay. On the ADI position, should I roll out of it? ADI is announcing earnings, right? I'll answer that one because that's obviously from a client in general, and that is our options play. Oh, there we go. ADI, analog devices. November 26th. Okay, so if you have the short-term option, yeah, that's what you're talking about. Because Al, I think the trade was a short diagonal. Let the near term expire if you want. You can close out the entire position. Market has moved up against that position. But the longer term option contract, you might as well ride it until that earnings report, which is on the 26th. And that's why that trade was put together, is to give you that opportunity to ride it through the 26th. Does that make sense? So the answer in short is no. I would let it ride and ride it into that expiration because this is going to be a volatile expiration. So why not have a chip in a chair and see where you turn out? David asks, can you do an hour on the options play tool? There are many things that are available, David. If you send a email to support at Options Play, they will gladly send you already recorded presentation that Tony, the CEO, Tony Zhang, CEO of the company, has done, and Tony is the master of this, and that's who you would want to work through all the nuances of Options Play. But they are available. Support at optionsplay.com and ask for a video. All right, all right. I got to be done. There's way too many that are popping up all over the place. Thank you so much. Whew, hour and 15 minutes long. Till the next time, my name is Brian Overby. You can follow me on Twitter at my handle at Brian Overby. Check out my website, optionsplaybook.com. Sign up for the free trial for Options Play by scanning the QR code or going to optionsplay.com/signup. Thanks for coming, everyone.